Good morning, traders. It's Mark here from Daytrading Room. It's 22:12 London time on with Thursday the 9th of June today. Apologies for a delay in the video. Been a little bit slack with that this week. Going to try and get on top of the videos and get them out more frequently for you next week. But we've just had so many opportunities in the market, and I've been trading quite a lot into the close, especially on Tuesday. We had a lovely drive into the close. We haven't had one of those for a while, and they are fantastic to trade. Loads of key levels in play. General downside bias, which always seems to give you profits quicker than the upside bias. So all in all, great opportunities on the YM. I'm on the laptop at the moment, so I haven't got my execution arrows in. But what I wanted to talk about really is not so much the YM. I want to talk about crude oil. I haven't traded crude oil for a while, as you know if you've looked at the videos. YM's offering enough opportunities to not need to look over another market. But yesterday we had some OPEC news. I'm going to just bring up the crude oil chart for you. Hang on. Where are we? There we go. Okay, there's a 1 minute chart. Yesterday we had some OPEC news around here, which they couldn't come to an agreement. Blah blah blah. Whatever it is, bullish. Okay, so we get what I call a reprice. Now, what is a reprice? A reprice is when there's a fundamental change in the market's value or perceived value. So if interest rates change surprisingly, then obviously bonds are going to move, dollars going to move. You're going to get that different valuation, if you like, for those specific markets. If you look at a company, let's say Apple, suddenly announced that their profits were down surprisingly, then you get a reprice. The fundamental value of the market changes, or the perceived fundamental value of the market changes. Now sometimes they can be dramatic, with a profit warning on a company, obviously you get a serious drop. But in the futures, especially looking at the oil here, it was something significant enough to cause a bullish reprice. This OPEC news, everyone was waiting for this OPEC news. It came out and we got this movement. So how to trade it, this is what I wanted to talk about with this video, and how I traded it, how perhaps you could trade it better, and just some tradable ideas from it. So the reprice started here. We can see that, we confirm that with the burst in volume. This is the average volume we've got, and we've just spiked up from 500 contracts a minute. That's a 1 minute chart, by the way. 500 contracts a minute, and we've just shooted up to 2,500, 3,000. Okay, and the important thing here is to see. I like to see sustained move. One candle can be a fat finger, can be something and nothing. Obviously, the larger the volume, the more likely it's going to be something. But I like to see 3 minutes worth of strength if it's a reprice in the up direction. Preferably solid candles, but at the end of the day, it's only an arbitrary time. The candle, the clock starts and then it ends at a minute, so a lot can happen in a minute. And if it just happens to end when you're a little dip down, you're going to get that sort of wick. But anyway, I'd like to see. I guess the best way of saying it is from there to there, a sustained move. And so this. Let me just zoom in a little bit better here. Hopefully, you can see this. Okay. I just want to see a sustained move to confirm the reprice. Okay, and then I'm looking for. There's two ways of trading the reprice. The first is the first small pullback, which is here. The second is the larger pullback, the consolidation that then continues with a much larger drive. Now there's advantages and disadvantages with both. Okay, the first small pullback is very much a tape read. You're looking to see the balance point shift from being aggressive buyers. The buyers back off for a second to see what's going to happen. They wait to see if the sellers are going to initiate some selling, if there's any supply coming into the market. That's what that little pause is. The shorter the pause, the more likely it is to be explosive the next move. So that's what we've got here. That there is just a small pause. It's very much a tape read. It's very much feeling the flow of the market, the strength of the market here, waiting for that to unwind a bit, and then watching. There's certain things to watch on the tape to see how, to see when that market may push up. Now, two things to look for are either large orders stepping up to the bid. them not being filled and the market backing away from them, creating that panic, or you're finding a bit of a brick wall. So the market is, if you look at it, if you zoomed into that, it would be more like this. The market's pushing down, counter trend. Now it either peters out and just drifts for a second or two before popping, or you get it trying to push but it just coming up against a brick wall. So in other words, a buyer is there soaking up all that supply, but he's passive, he's sitting on the bid, he's allowing that price to come to him. Now if you spot that, you've got a great risk reward, because you can front run him and you can have a stop behind him. So you've got the whole premise of it's the first pullback, I'm looking for the blast off. And in addition to that, you've got a trigger because you've seen a big buyer soaking up that selling. And in addition to that, your risk is nicely quantified because you're leaning on him. That's not to say you can't have another go if he lifts, but if he lifts and you take a few tick stop, it's meaningless in relation to the sort of pop you're going to get. So that's one way of approaching that first pullback. The second way of approaching it is to let's label that number one. Yeah, you got to forgive me for the for my crayon drawings. I must get myself a little tablet or something. I'm drawing with a mouse here. Okay, the second way of looking at it is you get the drive up, and get the pullback. Now this pullback then starts just to peter off. Okay, there's not buying stepping up as such, just the sellers aren't there. They've dropped it back a bit, the sellers just aren't there. And when you see that calm before the storm on the tape, you just see the time and sales just ticking ever so slowly, nothing much happening. Okay, then you see a bit of urgency to the upside, what I call expected response. You've got unexpected and expected response. I won't go too much detail today, but expected response, you then see green coming through your tape. You see a speed of the tape increasing. You see the depth of market reacting to that, i.e. the price starting to push up. So you're getting the expected response. You're getting the buying coming in and the market's lifting up. When you see that, there's your entry, quickly in, stop under the low, looking for a break of the high, perhaps taking some off of the high. So there's two different ways of looking at it. There are others, but we'll stick to those for now. You've got the buyer soaking up heavy selling, the brick wall, and then you've got the selling petering out and the buyer then getting urgency. So that's two ways of looking at that. Okay, so that's the first pullback, that's the urgent, that's the tape read. If you're not on that, fine. I wasn't on that because by the time I'd noticed it and got myself set up for crude oil and prepared, because I wasn't watching the market, I didn't want to rush into it. So I didn't take that first tape read. I didn't take the first pullback, which is one of my preferred ones. I prefer to do that because it is really tape reading. You can feel it and you get the instant reward of the pop up. Okay, but I've gone through that. So that's how to tape read that first pullback. The second way of trading the reprice is for the longer term consolidation, and I like to call it suck the suckers in. So you've got the drive up. Here's the drive, great drive. First pullback's already been done. So once you've had that first pullback, you know that you're not looking for a little tiny pullback anymore. You need a little bit more of an unwinding. The spring needs to unwind a little bit more. We need to get a few sellers involved in this, and we need some information. We need to see what happens. So we've got this pop-up. Okay, we got to the prior day's high. So it's a key level. It's a level that perhaps other people are looking at. We've also got the $100 above it, another key level. We've got plenty of upside. Where oil is, it's been in that range. So we've got areas to move. We're not talking anything spectacular in terms of fresh territory. So we're looking for a longer term unwinding. Now what am I looking for with that? Well, the premium entry for me is exactly what we got here. Basically this was textbook, which is why I've taken the time to run through this, because I think it's great to document for myself, to go back and run through, look through this setup in the library, and for you guys to see a couple of ways that perhaps you can implement these ideas with your own trading strategies. So yeah, we've had the first pullback, so we know we're not looking for a little pullback anymore. We know we've got to wait for a bit of an unwinding. We want to suck in a few sellers. Now you're either going to get this counter trend, it'll drive down, or you're going to get a flag pattern, pretty much like we got there. Flag patterns are the more bullish. Okay, and you want to see what's happening. Now we had a lot of oscillation here. We had sort of attempts to push up. So there was obviously a seller there. So we're looking for two things: either the seller to back off, and we'll take the break of that of our little tape resistance at this point here, or my preferred entry, and is the entry I took, is for selling not expected selling not to happen. So here we got the pullback. Let's just look at it. If I just draw it here, we've got the oscillation here, then we got this little candle here which pulled back. Okay, now you'd expect sellers to take the opportunity then to jump all over that, buyers to close thinking, oh, that's the end of the run, and would get them further moved down to here. That's what you'd expect if that candle was genuine. This candle here was genuine. I just pointed at the screen then. You can't even see me pointing at the screen, can you? Obviously. I don't know why. I'll use my pointer. So that's the candle that we're looking at. That's the candle. That's the key candle. Okay, we're breaking below the low. Okay, if that closes and starts to drift lower, we're talking a little bit of a different setup. We're talking a pullback setup. But it didn't. Immediately, it pulled back up. So immediately, buyers are interested, sellers are not interested. Buyers are more aggressive at the bottom of that candle. So that's our entry, expecting now we've sucked in enough people, we've had 4 or 5 minutes of drift, we've pushed lower, making people a little bit more excited, then we've pushed back up, we've got our risk quantified, okay, just under that candle, and we've got some great targets in mind. Now, being the type of trader I am, I like to take some off on the first impulse. So the entry, I don't think it was low, it was mid 50s, maybe it was low 60s, but just after we'd performed that low there, risk quantified, I'm in, and I'm looking to take some off on the first impulse in my direction. The first impulse for me was this, and this was a little bit sneaky actually. Preferably you wouldn't want this here, you just want that drive up, but it formed that little wick, and as it formed that wick, as it pushed back down into the 80s, I took half off the table. Definitely not going to hang around just in case. I'd like to quantify the risk, and it just becomes a free trade for me. But really, the actual meat of the move is this, and it's unfortunate we've got that wick, but you know, the market does what it wants. Then we got the drive, then we got the push up, and I was all out of the 100 actually, because that's what I had as my target, which is still a very, very nice trade, very nice trade. But maybe you guys can trade it better. Maybe you guys can look for longer targets and look, you know, to manage your exit like that. But we're just talking about the entry here and how to trade those reprice moves. So just a quick summary. First pullback is very shallow. It's a tape read. We talked about either we're looking for buyers holding or sellers drying up. To get onto that, that's nice. I like that because it's instant profits. If it works, you know you're right, you know you're wrong. The second way of trading is to wait for the longer term pullback. I say longer term, you know, we're still talking short term trading here, guys. 3 or 4 minute pullback, little probe against the wicks just to catch a few people out. Then when you see that, that's your confirmation that you want to take the trade because your risk is quantified. There's the stop. We've seen sellers not be able to overcome buyers that have perceived that as value, and the next obvious or the next likely move is going to be for a probe up. This is unfortunate, we've got this little wick here, but I'm always going to take out half anyway at the high, especially if there's a reasonable bit of meat in it anyway. You know, I like to take it off on the first impulse. I like to manage risk. That's what I'm about. So once you've got your entry, you can manage it as you see fit, you know, looking for extended targets, or even, you know, I know guys who utilize tape reading and utilize this short-term thing, and hold for a longer position. You know, they may think, okay, this is a permanent reprice. I've been looking for an entry long on oil for a while, and using that sort of scalper's entry for then a swing trade. So anyway, a little bit of a different video today. Just thought I'd go into a little bit more about order flow and tape reading, rather than just going through my trades and I did this, I did that, and I got stopped here and I took profits here. Just something a bit different, just mix it up a little bit. Okay guys, I hope you have a great Thursday and Friday trading. As always, please manage the risk. That's my number one thing. I always looking to manage the risk. No matter how great the setup looks, it can just turn on a sixpence, and if you're not prepared for it, it can just catch you out and undo a lot of good work. So take the stops. You've seen me last couple of videos, 2 videos ago, or last video, you know, took a stop at the low. That's the way it is, guys. If you want to manage your risk, you got to be prepared for that. And even if, you know, even if that wicked and then wicked and stopped you out there, fine, you know, that you just got to live with it. That's trading. Nothing saying you can't look for another entry if it's in your trading plan, but don't keep chasing stuff that's obviously not working. So yeah, manage your risk, guys. Great trading. I've signed up for another trial for GoToWebinar. So when that comes through, they actually ask for your credit card, but then if you don't sign up, then they say you can have it for free. So I'm just waiting for them to come through on that. But anyway, if it becomes a regular thing, then obviously I'll get a proper account on GoToWebinar. But yeah, so once that's through, then we'll go for our second webinar. I'm going to try and I'd like to get it on Monday, really, but I don't know if I'll get the login through in time. But anyway, I'll keep you posted. We'll do that. That's long time planned, and we got that postponed, but definitely that's going to be done. Run through some order flow stuff and just general chat about the markets. Okay, traders, good trading. Manage your risk, please manage your risk. Back with another video probably over the weekend. Take care.